All right, so DoorDash just dropped their earnings, and man, at first glance, the numbers looked kind of weak, a classic miss. But then you look at the stock, and the reaction tells a totally different story. So let's break down what Wall Street was really looking at beyond those initial headlines.
And this is the big question, right? The puzzle we're going to solve today. Dash straight up missed on revenue and earnings. Normally, that's a one-way ticket down for a stock. But instead, it soared. So what gives? What did everyone else see that made them hit the buy button like crazy?
Okay, let's get into the nitty-gritty here. You can see the hard numbers right on the screen. The misses were pretty clear-cut. Earnings per share, what we call EPS, came in 11 cents short of what analysts were hoping for. And revenue, also a bit light, missing the mark by about $30 million. No way to spin it. Those are misses.
And you know, that 11-cent miss on the bottom line, that's exactly the kind of thing that the trading bots and the first blush news headlines just latch onto. It's simple, it's clean, it's negative, easy story. So if you're just looking at that one number, the trade is a no-brainer, right? You sell. The company didn't hit its targets, you'd fully expect the stock to get punished for it.
And that's exactly what happened right out of the gate. As soon as those numbers hit the wire, the stock just tumbled. It was down about 7% in after-hours trading. Totally logical, totally predictable, everything's going according to script. But, and this is where it gets interesting, that predictable reaction didn't last, not even close. Because once people, the actual human analysts and investors started digging into the full report and listening to what management had to say on the call, the whole script got flipped on its head. And I mean, the reversal was just dramatic. The stock went from being down 7% to absolutely ripping higher, finishing up over 13.5%. We're talking about a massive 20-point swing in just a few hours. That's a huge signal that the market completely threw out the rearview mirror and started staring straight ahead at the future. So here's the key takeaway, something we see play out every so often in the market. It's the classic numbers miss, narrative win setup. The market just decided to ignore the backward-looking stuff, the EPS and revenue miss, and instead grabbed onto this incredibly powerful forward-looking story. And that story was all about a monster beat on a key growth metric, super strong guidance, and a really bold vision for the future. So what was this amazing narrative? Well, it all started right here, with the one metric that completely changed the game, gross order volume, or GOV. Think of it as the total cash value of everything ordered on the platform. Wall Street was looking for around $29.2 billion. DoorDash comes in and posts $29.7 billion. Whoa, that $500 million beat was a massive signal that the core engine of this business is just running way, way hotter than anyone thought. And it's not just one thing. That powerful engine is firing on all cylinders. Check this out. Total orders up 32%. GAAP net income up an incredible 51%. They've got over 56 million people actively using the platform now, and a whopping 35 million of them are paying subscribers. I mean, you look under the hood, and every single key metric is just screaming momentum. Okay, so what about looking forward? Well, the guidance they gave was mixed. And this part is really important to understand. They guided for that all-important GOV number to be way, way above what Wall Street was expecting, a huge sign of confidence. But then they guided profitability, adjusted EBITDA, to be lower than expected. So wait a minute, why would the market cheer that? Well, it's because management was super clear about the why on their conference call. They basically said, look, we're not missing profit targets because the business is struggling. We're choosing to spend a lot of money right now to invest in making this company an absolute beast for the long haul. And this is the absolute core of their entire strategy right now. They're sinking hundreds of millions of dollars into a massive project, merging all their tech, DoorDash, Wolt, Deliveroo, onto one single global platform. The trade-off is really simple when you think about it. Take a hit on profits today in order to build a machine that can innovate and grow way faster all over the world tomorrow. And let me tell you, the market absolutely loved that long-term thinking. Another huge piece of the puzzle that came up was the battle for grocery delivery. Management was really direct in comparing their strategy to Amazon's. Amazon is all about owning everything, the warehouses, the inventory, the whole shebang. DoorDash is doing the opposite. They're betting on partnerships. They want to be the platform where you can choose from all your local grocery stores. It's their big play to carve out a massive piece of this new market. Okay, so that's the whole story. With all of that in mind, what's our call on the stock now? Our rating here at Talk Tickers is outperform. It's pretty clear. the market has sent a massive signal that it's more than willing to fund this big investment plan because it believes in the long-term payoff. And our thesis is really straightforward. First, the market is clearly prioritizing that strong, durable GOV growth over any short-term profit worries. Second, those new businesses, like grocery and retail, look like they're on a solid path to actually making money by the second half of this year. Third, yeah, this tech rebuild is expensive, but when it's done, it's going to be a huge competitive moat. And finally, that Deliveroo deal, it's already starting to bear fruit, growing even faster than they expected.
All right, so if you believe the thesis, how might you actually play this? Let's talk about let's call it an outrageous but plausible trade idea.
Okay, so the idea revolves around using long-dated call options. Here's the thinking, step by step. Step one is the thesis we just talked about. The market is going to keep rewarding this growth story all year. Step two, the trade itself. You could buy call options that expire, say, 9 to 12 months from now. That gives you a way to capture the potential upside while clearly defining your risk. Step three, what are you watching for? Well, any good news about that big tech project or signs that grocery is getting profitable faster than expected, those are your catalysts. And finally, step four, what's the risk? The big risk is that the market suddenly gets impatient and starts demanding profits now, or DoorDash just stumbles and has delays with this big tech rebuild. You know, there was a great analogy on the call that just perfectly sums all of this up. Management is basically asking for patience while it rebuilds the entire plane while it's still in the air. They're spending a fortune to upgrade the whole company while it's flying at full speed. It's a classic high-stakes, high-reward bet. And that really leaves us with the big question for anyone looking at the stock. Will this rebuilt plane actually reach a higher altitude? Or is all this construction work going to create some unexpected turbulence that sends it into a tailspin? That's the billion-dollar question. So that's our take on the DoorDash quarter. And as always, please remember, this is for informational purposes only. It is not financial advice.